Hello, everyone. So, welcome to my home buying and financing webinar. I put this PowerPoint together so I can educate people on the home buying process and the financing portion of purchasing a home. A lot of times, people do not know what they're getting themselves into or don't know the process of both the home buying and financing portion. So, I wanted to bring this information to you. My name is Coretta Montague-Smith. I am a real estate agent and broker with Montague-Smith Realty, and I am also a loan officer with Loan Factory. So I'm able to help and assist on both ends of the transaction if need be. So, topics to discuss in this webinar that I would like to go over is first the home buying process, which is 10 steps, the process of funding, which is 5 steps. Factors that determines the qualification for a loan is 4 factors, and a lot of people it just know about that one factor, and that's the credit report, the credit score. But there are also 3 other factors that will allow you, it will tell you if you approve for a loan. Then we're going to go over some loan programs, products, and qualifications. So depending on those 4 factors, it will tell you if you qualify for a conventional conforming loan, if you qualify for that conventional non-conforming loan, or the non-conventional loans, those government loans, those FHA, VA, USDA loans, right? So depending on the loan product um, that you qualify for goes by those 4 factors. 4 legs to a table. Then we're gonna go over the basic loan application required documents and next steps if you want to move forward with purchasing a home or even just getting approved for a loan. So the first we will go over is the home buying process. There are 10 steps to the home buying process. First, you want to find the right real estate team, get approved for your mortgage, set goals based on your needs versus your wants, which I'm gonna go into all of these topics thoroughly. Then we're going to talk about shopping for your home and making the offer, getting a home inspection, negotiating the repairs and price reductions if need be from the home inspection. We're going to talk about the appraisal and the paperwork needed during appraisal time and verification time. Then step 9, we're going to be inspecting your home before settlement date or closing day. And then the end of the home buying process is in a settlement. So let's talk about it. First step in the home buying process is finding the right real estate team. So a lender and real estate agent are important partners to your home buying process. Buyers are now required to pay their buyer's agent a sales commission. The fees are no longer automatically covered by the seller. Usually, a seller before July 2024, the seller will give a buyer's agent a portion of their commission for basically bringing them a buyer for the seller. Now, there are 2 agreements for the listing agent and the buyer's agent. So we are now able to ask for seller's help with closing, but it's not mandated. It's not mandatory. So when you're going through this home buying process, don't expect for a seller to have to help you with closing, because you also got to remember that this is their property that they're selling. If you're selling anything of your own, you want to make sure that you get your net profit, as much money as possible, right? Okay. A good real estate agent will disclose to you upfront any costs or fees that you may be required to pay. Always ask so there will be no surprises if they don't disclose those fees. And that's basically now their commission. How much is they charging to help you go through this home buying process? Real estate agents have the option to provide you with a preferred lenders list. This list contains lenders that have a great reputation with your agent's past buyers. Okay, laws change again. So now, if any agent in Maryland, um, they give you any type of list, any type of referrals, far as home inspectors, far as title or closing agents, far as contractors, they have to make sure that these people are licensed. So to take the liability off the agent, they now say you have to find your title company. You have to find your lender. You have to find those home inspection companies, et cetera, et cetera. Because if we refer these people to you and they're not licensed, that's a $500 per offense ticket that we have to pay. So your best preferred recommendation to get these lists? Google. Google have reviews on different companies, on different people's, on their services. So that's um some information for you to know now. A lender should not only be knowledgeable in the lending products, but should be available when you need them. Often buyers will select a 9 to 5 lender Monday through Friday and feel disappointed when they can't reach them in the evenings or weekends. The real estate market is competitive. Response and availability can be the difference between getting or losing the home of your dreams due to lack of communication with your real estate team. And that's one reason why I became a loan officer. For the simple fact, when I have buyer's agents, they need a pre-approval letter during the weekend. They can't get in contact with their lender because they only work Monday through Friday. So the seller says that their last offer, they taking their last offers on this Saturday. The buyer can't put in the offer because they don't have the pre-approval letter. So now what? Because it's on the weekend, they needed an updated pre-approval letter. So it's best to make sure that you're able to communicate with your lender and your real estate even off hours. Not to say call them 3, 4 o'clock in the morning. Be respectful, but if you have a question, you should be able to get an answer from them. Different means: text, email, phone call. So step 1 is find the right real estate team. Step 2, once you find your real estate team, you get approved for your mortgage. You get approved for a loan before you begin shopping around for their home you would like to buy. Benefits include you will know your price range, closing costs, and monthly payments up front. That's what the loan officer will give you. You review only those homes within your price range to save you and your relative time. So that means if you were approved for $250,000 and this home is $300,000, do you have $50,000 already in your bank account to pay the difference if you get accepted for this loan? If not, what is the purpose of going out and looking at this $300,000 home, right? So you only want to view only those homes within your price range to save you and your relative time. Negotiation position with the seller is stronger. The seller will know that this company just approved you for this loan to help me purchase this home. So your negotiation position is much stronger to be able to get accepted for the loan. Closing on your new home can happen more quickly because you already contacted with the loan officer. You already about to be contacted with the title company, so the loan officer, the loan company can send the money over to the title company. So your closing on your new home can happen more quickly. If you don't qualify now for a loan, a great lender should point you in the right direction to get you approved in the future. He or she should also educate you on all the products that you qualify for, including any grants or free money opportunities. Select a loan that fits your needs. Now, far as on the loan officer support side of things, if you have a low credit score and you need to boost it up, your loan officer is able to recommend credit repair companies without being liable for anything, right? So your your loan officer should have that list or be able to help you boost up your credit or tell you what you need to do. I am affiliated with a company that help you boost your credit score up in 30 days. It's going to cost money, but you can purchase line of credits. You can get stuff off your credit report and it don't come back. So that's the benefit of working with me as well if your credit score is not up to par where it needs to be or wants to be. That's the first thing you can do. But step 2 is getting approved for your mortgage. Step 3, you set your goals based on your needs versus your wants. So once you get that pre-approval letter, it's time to start searching for your home. Don't confuse what you want with what you need. Start out by taking the time to list everything you need in a home. These are your must-haves and deal breakers. Your needs in a home. I have a big family. I have to have a 4-bedroom home. If you have to have a 4-bedroom home, why are you putting in to look at homes that is 2-bedroom? I have to have a garage space because I have all these cars. Then why are you looking at homes that don't have this garage space? You know? Because even if you do see this home, what happened to the PowerPoint? I'm sorry. Even if you do see this home, um, you're not going to like it because it's not in your must-haves. Then you list what you want. Typically, these can be in two categories: the got to have and the nice to have. These are those things that you can live without or add at a future date or substitute for another feature. There are a ton of things to consider, like water views, garages, fenced yards, fireplaces, neighborhoods, attached homes, amenities, school districts, and so much more. So what I conduct is a buyer needs analysis. This is a document to actually help you go over what you have, what you need, what you must have, what you don't need. With my buyer needs analysis, I also, if you are purchasing a home with a spouse or maybe a sibling, I send this buyer needs analysis so y'all can discuss these things together because you want to be on the same page when purchasing a home. There's a lot of times, again, when I had taken people out to look for a home and the wife and husband is not on the same page or what they want in a home. So it's discrepancies and it's a waste of time looking at homes that you're not going to like anyway. Husband said he wanted a basement. Wife doesn't want a basement. What's the must? What's the um? Is it a must have or is it not a must have? So that's the stuff that you have to think about. It's important to have an idea of what you want up front. Do you want a move-in ready home or do you want something that requires a little tender loving care to make it more like a custom home? Your lending product may have to be altered based on what you want up front, based on what your needs. Ask your lender or real estate agent about renovation loans that can allow you to purchase and fix up your new home as well. Right? So that's step 3. Set your goals based on your needs versus your wants. Step 4 of the home buying process. After you find a home, it's time to make an offer. What you offer on a property depends on several factors, including its condition, length of time on the market, buyer activity, meaning how many buyers are actually looking at this home and putting in offers, and the urgency of the seller. While some buyers want to make a low offer just to see if the seller accepts, this often isn't a smart choice because the seller may be insulted and decide not to negotiate at all with you. Um, when you put in an offer, you want to put in an offer based on those things that I discussed: the buyer activity, how much time is on the market, what is the market going for in that area. Each market is different. It going by zip code. So when someone comes to me and asks me, how's the market? Well, what zip code are you in? Each market is different, right? So you want to make an offer on what is going on in that market. Often, the seller plans on leaving major appliances in the home. However, which items stay or go is often a matter of no negotiation. They will have the document or what they're leaving in the home, and you can also ask for things that is in the home to be left. Agents will present the offer to the listing agent and or seller. The seller will either accept, reject, or counter the offer with changes. When the seller accepts the offer, then this becomes a legal contract. Now, what I have seen is that real estate agents is not doing any counter offers whatsoever. So when you put in an offer, you want to put in an offer at your highest and best offer there is. Because what I have seen agents are doing is they collecting all these offers, um, a pile of offers, and then they present all of these offers at one time to the seller, and then the seller pick which one best suits their needs and their wants, right? So if the seller is accepting this $400,000 home, but then one of the other offers, they one of the other offers, one of the people, they're not going to know how much they was offered or how much they accepted on that offer. Agents is not even expressing that to those that didn't win the bid, you know. And I think that's just like really crazy right now. That's just that's a whole nother story, a whole nother topic. So if you want to put in an offer, make sure that you put it in your best and highest offers the first time. Because I have not been seeing in the last 4 or 5 years, um, the extra step being taken from agents doing a counter offer. Also, when you put in an offer, you need to have a earnest money deposit. I didn't put it in this slide. Earning money deposit is basically stating that you are serious about purchasing this home and you want to take this home off the market, right? So with your offer, you have to have the pre-approval letter and also earnest money deposit. Earnest money deposit, I say, should be 1 to 3% of the home purchase amount, the selling amount. Um, with the earnest money deposit, it goes to your closing costs, and if you try to renege or get out of the contract, the earnest money deposit will go to the seller. So basically, the earnest money deposit is basically just to get the house off the market, and it will help with closing costs. It will go to your closing costs. So that's what you need for the offer. That's step 4 of the home buying process. Step 5 of the home buying process is getting a home inspection. All homes aren't created equally. Once your offer is accepted, your real estate agent should assist you with setting up a home inspection. Home inspections should be performed by reputable companies that provides an in-depth analysis of the home and can uncover items that need immediate or future attention. This could save you from purchasing a home that is in need of repairs that cost more time and effort than you're willing to spend. The home inspection is at the buyer's expense and it is paid for at the time of the inspection, and it typically costs ranges from $400 to $500 depending on the market. But inflation has, you know, increased, is here, but I still have it. I see the highest I've seen with some companies is $650. But again, this is something home inspectors, this is something that the buyer has to decide at third party. Agents can give you a list, but 9 times out of 10, they don't want the liability to make sure that they are licensed. So Google can be your best friend in this circumstance. Also, when a home is being sold as is, even though the home is being sold as is, you still want to get a home inspection because you want to know what's wrong with this home. The home inspection actually is educating you about the house themselves, about where pipes and certain items is in the home, the furnace. It's actually educating you where the chimney, where drainage at, etc., etc. It's basically educating you about your home. So you want to get a home inspection. Never not get a home inspection because you don't want to pay that fee. Because later down the line, you will be regretting it. So step 5 is the home inspection. Step 6 of the home buying process is negotiating any repairs and or price reductions from their home inspection. So if your home inspection uncover repairs that you are not comfortable living with, your real estate agent should negotiate with the seller's agent to get repairs completed. an allowance for the repairs, or a price reduction prior to moving forward in the transaction. With home inspection and with homes that are not new, you got to remember that these are used homes. Every little thing in a home inspection, you can ask for it to be repaired, but don't expect for the seller to repair every single thing. Far as like they want the paint a different color, you know. Um, they don't like the countertop. All these cosmetic stuff, those things are something that you can customize to you and your needs. What you really want to make sure that you get repaired is anything dealing with the roof, anything dealing with the furnace, electricity, plumbing, the appliance that's left over, the refrigerator, the stove, like big things. Not it's just it's just so many like little tedious things um that someone sometimes they ask for, but I'm just saying you want to make sure that the major items in the home get repaired because they are the bigger expenses, and don't just pick point just little things, because that's another reason why a seller could deny your offer, right? Because just because you send it over that you want these things done, the seller do not have to do it at all. So it's either you accept what they're going to give you, you're going to accept this home inspection and what they want, um, and what they are offering to fix, or you can get out the contract. And when you get out the contract, that means you already paid for the home inspection, you're out of money for it. You pay for your credit report. You already put money into this transaction. You know what I'm saying? So just be mindful of those repairs that you want to negotiate with during this step. Step 7 of the home buying process is the appraisal time. So the appraisal is performed by a third party appraiser whom your lender hires on your behalf. So you don't worry about the appraiser because the lender is going to send out an appraisal for you, for them. The appraiser works for both you and your lender to ensure you are purchasing a home that its overall condition is acceptable for the mortgage product you have chosen, and that you are purchasing a home at or below its market value. So, where a home value appraises for less than what you have offered, the buyer typically has three options. They pay the difference, they ask the seller to reduce the price, or terminate the contract to purchase. So, for instance, um, the home is selling for $300,000, while the appraisal says that this house is only worth $280,000. So you have the option of either having putting down that extra $20,000, asking the seller to reduce the price, or terminating the contract because you're not going to get funded for that loan if you don't have the money to purchase it, right? If you don't have that down payment amount. Appraisals in most cases are at the buyer's expense, and payment is due before the appraisal is scheduled. And it typically, again, it ranges from $475 to $550, depending on the market, depending on where you're living at. So that's step 7 of the home buying process. Step 8 of the home buying process is paperwork, paperwork, and more paperwork. So, excuse me. When you're at the appraisal process of the loan, you are normally in the home stretch to obtaining the keys to your new home. Your lender and closing agent, also known as a settlement agent, will begin to ask you for paperwork that's required to get your mortgage loan package to the underwriter for final review. Some of the items that may be needed are letters of explanation, tax papers, updated pay stubs, homeowners insurance policy, proof of debt payoff, etc. So let me tell you this. When you first started the home buying process and you went through that pre-approval stage where you received that pre-approval letter, those same documents is needed at this time. All updated documents. They want to make sure that you still have the income that you say you have. They want to make sure that you still have your settlement money, your closing money in the bank. Now, letter of explanations comes in when you gave the lender a bank, say like PNC Bank, where you have your down payment and closing costs in this account. So all of a sudden, you either get big deposits into this account. They want to know why, where this money coming from. That's a letter of explanation. Or if you withdraw a lot of money from that account, they need letters of explanation. So everything that you gave them in the pre-approval stages, they're going to need it to basically be the same right here as well. When you are purchasing a home, don't get your credit ran to buy something else, to go out and look for a car, um, for new credit, for new credit cards. Don't get your credit ran because your credit score needs to still be the same during this time period. If any of those documents is not the same from your pre-approval, you put in all that money, home inspection, even appraisal, and now you won't be funded the loan because something changed. You know? So I just want to give you a heads up on that because a lot of people does that. That's because they in the home process. Wait till you got your keys in your hand to want to do something else with your credit. Or make sure um your bank account statements are still the same. The amount that's in it still the same or just a little bit more at this time before start purchasing other things, right? So step 8 is paperwork, and more paperwork. Verifying your pay stubs. Verifying that you do that have the homeowner's insurance policy already in place for settlement. Step 9 of the home buying process. Inspect your new home before closing. 24 to 48 hours prior to settlement day, you should walk the home one last time with your real estate agent. This is called a walkthrough and it serves two purposes: to ensure the home is in the same condition as agreed upon, and to ensure any repairs that were requested has been done and is in a workable manner. A lot of real estate agents do not do the walkthrough. So by going through this webinar, you should be taking notes. So if you choose whoever you choose to be your real estate agent, they will know to do this step 24 to 48 hours before settlement. On closing day, your real estate agent should accompany you to the closing agent's office to sign your mortgage paperwork. If your mortgage loan requires a down payment, your closing agent will give you wire instructions. It's always best to wire the funds at least 48 hours to the escrow account to ensure no delays in closing. At closing, you will be receiving the keys to your new home, and just to be mindful, make sure that you know to change any locks for safety reasons as well. So that's step 9, inspecting your new home before closing, that 24 to 48 hour window. And in the settlement, that's closing day. Step 10, the last step in the home buying process. So the closing day marks the end of the home buying process and the next chapter in your life with your home. Transfer or title moves ownership of the property from the seller to you. The two events that make this happen are delivery of the buyer's funds. This is a check or wire funds provided by your lender in the amount of the loan, and the delivery of the deed. A deed is a document that transfers ownership of real estate. The deed names the seller and buyer, gives legal description of the property, and contains the notarized signatures of the seller and witnesses. At the end of the closing, the deed will be taken and recorded at the county's clerk's office where the property is located, and it will be sent to you at the processor, usually within 30 business days. So, these are the 10 steps to the home buying process. If you have any questions about the home buying process, I will love to answer them. Leave a comment below with your questions. So the next portion of what we're going to be discussing in my home buying and financing webinar is the process of funding, the lender portion, how to finance your home. There are 5 steps in the funding process. So let's get into it. Okay. So step 1 is the pre-application. Borrower consider shopping for a lender and or loan officer through advertisements. The borrower has a 14 to 28 day shopping window to apply for loans to find the best rates. And the only fee a loan officer can charge before receiving the letter of intent is for the credit report pull. So let me discuss this a little further. So borrower consider shopping for a lender or a loan officer through advertisement. A lot of people ask, well, um, who should I go through to get my loan, to apply for a loan? If you have a good relationship with your financial institution, the retail banks, far as your credit unions, far as your savings account, credit card companies, these Bank of Americas, PSCs, these retail banks, fine, that's great. But what I suggest is that you go through a loan officer. Why do I suggest this? Because if you apply to your financial institution, that's one application that you have to that you put in. And you have, if you want to shop around for the best rates, not just that company. So you have a 14 to 28 day shopping window to apply for as many loans as you want before your credit start being affected. Whereas if you go through a mortgage loan originator, a mortgage broker, far as Loan Factory, far as Rocket Mortgage, that's another one. Whereas you only need to put in one application, and they can pull up all the products and loans that you qualify for. So you only have to do one application. Whereas if you shopping around on your own and going to these different small banks or big banks, that's retail banks, um, the disadvantage is that they have set criteria for their loan products. So if you, for their FHA loan, if they want a 680 or 720 credit score, that's what you need, a 720 680 credit score. Whereas if you go through a loan broker FHA loan, you can find, they will find you a product if you have a 640 credit score. You can go through, and there's only one application that you have to put in. And all these loan products that you qualify for with just with your criteria will be presented to you. So if you go through a retail bank, you have a 14 to 28 day window to shop around for the best interest rates as possible. Or you go through a mortgage broker where you'll need to put in one application. Interest rates changes every day. So when you're ready, you can lock in the interest rate, and they can work with you with the interest rate that you want. With a loan officer, you have to pay for your credit report. If you go through different banks, they may want you to pay for each credit report by themselves, where you only need one credit report pull for the mortgage broker. Some people ask, well, can I use my credit report that I just purchased from somewhere else? No, you cannot, because the mortgage broker needs to actually own your credit report so they can be able to tell you what you need in order for your credit score to go up. So they can be able to send your credit report to their credit repair company so they can go line by line on how you can boost your credit up with line of credits that you're able to be accepted for. So no, you cannot use another credit report from another company that you got from another company to upload to another company's portal. They have to own your credit report. So that's the benefit of going through a retail bank and going through a broker. So that's the pre-application process of funding. That's step one. Okay, let's go through step two. All right, step two of the funding process is the application process. First, your credit is pulled and verified. Then your application is collected. The loan officer matches the borrower product with the loan product that you qualify for. That's when you're going through a mortgage broker. And I'm a mortgage broker, so I'm just telling you the process of the mortgage brokers. I'm not telling you the process of the retail banks because it's different criteria with each bank. So you get the credit report, application is collected, your loan officer matches the borrower with your loan product. Then the intent to proceed is provided, and you have 10 days to respond. So once the loan officer tell you that this product is what you qualify for, you have to actually tell us that you wanted to proceed with this loan product. And you have to respond, or the application can be withdrawn within 30 days. That's how we can stop the process, and we have to have a paper trail of that. That's one of the disclosures. All our disclosures are due at the application or within 3 business days. There are other disclosures that we have to present to you. Your loan estimate will be given to you, and it provides an estimate of the cost of settlement. Also, it will tell you your interest rate. It will tell you your monthly payments, etc., etc. But that's the estimate closing costs. You will receive a home loan toolkit. It informs borrowers of the home purchase process, which I had explained to you. The home purchase process in the beginning of this webinar, but you also will receive a hands-on home loan toolkit document about that. You also will receive home counseling organization list. This informs borrowers of at least 10 local counseling organizations, and these companies help you with down payment assistance. So you'll be able to receive this document from your loan officer. If this loan officer do not give you this document, this is something that you need to ask for because you want to get as much help in purchasing your home as possible. And the home counseling organizations list, it goes by county. What one county offers, the other county may not offer it. So wherever you purchase in your home at, that's the home counseling organization list that you need. You also will receive an MSDS. This informs borrowers that their loan may be assigned to another servicing company. Um, this is basically how you make your payments after the loan. And then there's a mortgage service disclosure statement. That's what MSDS states. The mortgage service disclosure statement. This is basically just saying that your loan, someone else may be servicing your loan. This is where you're gonna be making your payments to. So that's step two of the application process. All right, so step three of the funding process is the processing. Documentation is collected for the loan product. Assets and documentation is verified. That's your bank statements. You also have to sign Form 4506C, and the form is a request for your tax transcripts from the IRS. So you can't get over on how much you make through your pay stubs because you will have to sign this full 4506C document so the loan company can get your tax transcripts. Also, the processor prepares the borrower's paperwork before sending it to the underwriter for approval. So this is the processing step for funding your loan. Step four of the funding is the underwriting. The underwriter verifies that the borrower qualifies for the loan and either approves or denies the loan. The pre-approval letter is given to the borrower with the loan amount that they qualify for. So your loan will be going through the underwriter to get the pre-approval, and then we're going back through the underwriter when it's paperwork time during that home buying process to make sure that everything is still the same from that pre-approval. Now, step five of funding is closing. Documents are signed by lender and borrower, and funds are dispersed and documents are recorded by the closing agent. So, step five of the closing for funding, it all happens basically during settlement time, and that's the end of the financing process. Now we just finished the funding process, and now I would like to go over the factors that determines qualification for those loan products. So there are factors that determines what loan product you're qualified for. I called it the 4 C's, which is credit, capacity, collateral, and cash. So let's go into more detail of each one of those. So the four determining factors I say is four legs to the table. First is your credit, the borrower's credit score and credit history. Then we have the capacity. This is the borrower's ability to repay the loan back, the debt to income ratios, your pay stubs, how you are able to get paid your income. So that's the capacity. Then we have the collateral. The collateral is the property pledged as security for the loan to value ratios. How much the home is worth compared to the loan. That's collateral. And last is your assets, your cash. So you need all four of these things when you are applying for a loan. All four of these things will determine what loan you qualify for. And you may not have all of these things. Some loans they just want to see your liquid assets, the non-conforming loans, non-conventional loans. I'm sorry. Where you just need bank statement loans. We have loans out there that's verification of employment, where you just need to verify that you be employed at this employer for at least 4 to 5 years. You know, but the main four determining factors is the credit, capacity to pay, collateral, the house itself, and your assets, the cash. And if you have not known, your liquid assets also can be your whole life insurance policies. Um, the cash value in your life insurance policies or your 401ks, your retirement accounts, you can actually purchase a home with those assets. Is so you don't have to just use what's in your savings account. Just want to make that clear if you did not know that. So they was the four determining factors. So now the depending on those four determining factors, let's go over some loan programs and products that using those 4 C's, which you will qualify for. So we have the conventional loans. These is the conforming and non-conforming loans, and then we have the non-conventional loans. The non-conventional loans are the FHA, VA, USDA. They are backed by government insurance or guarantees. So we have the conventional loans, and the non-conventional loans is basically the government loans. So let's do conventional conforming loans. Fannie Mae, Freddie Mac sets the underwriting standards for conventional conforming loans, so these loans can be sold in the secondary market. So when they be sold in the secondary market, that's when the servicer changes. That's why you would get that document as settlement, the MSDS document, stating that your servicer may change because your loan has been sold in the secondary market. So with the conventional loans, confirming loans allow consumers to get a loan for a second home or an investment property in addition to a primary home. So these conventional loans is basically for investment properties or second homes. The 4 C's, let's put it in play. You need a credit of 620 or more, the capacity to pay your debt to income ratio. The front end is 28%. That's the housing debt to income, and then the back end is 36% total debt to income ratio. You don't need to do the math on it. The loan officer and the systems will do the math for the capacity, but that's the debt to income ratio. Then we have the third C, cash. Closing cost funds must be verified. You need the bank accounts, retirement account, gifted funds, which you would need a letter for. That's the cash. For investment property, you need 6 months of reserves needed to be verified in those bank accounts. And then the 4C, collateral. Your maximum loan to value is 95%. So the loan product, the loan officer, the loan company will give you 95% of their loan amount. So you would need 5% down payment. PMI, required for conventional loans with loans to value greater than 80%, and that's insurance. Once loan reach 80%, the borrower may cancel the insurance if your mortgage payments has been on time for the previous 12 months. And then the PMI, primary mortgage insurance, automatically falls off at 78% loan to value. In other terms, you will have equity in the home of 22%. That's when the PMI drops off. Okay, so we have the conventional non-conforming loans. Conventional non-conforming loans does not meet the requirements of Fannie Mae and Freddie Mac. These are subprime loans, and most lenders do not offer these type of loans anymore. This when the real estate crash in 2008 to 2010, they was only giving these subprime loans. These loans do not have no set requirements. Products available for the conventional non-conforming loans are jumbo loans, niche loans, adjusted rate mortgages, GPM, and subprime loans. Subprime loans, borrowers meet at least one of the following requirements. So with the conventional non-conforming loans, you don't need all four C's. You only need just one of these, and you still be able to get a loan. So we have minimum credit score 660, a maximum debt to income ratio that exceeds 50%. You can get a loan that you have a bankruptcy within the last 5 years. Um, on your credit report, you have delinquencies 2 or more 30-day, or at least 160-day, or delinquencies in the last 24 months. Or on your credit report, you have other judgments, foreclosures, repossessions, or charge-offs in previous months. So with the conventional non-conforming loans, not all companies does these, especially retail banks. But if you go through a mortgage broker, you'll be able to get a conventional non-conforming loan if you have one of these issues, or if you meet one of these criteria. So that's conventional non-conforming loans. All right, so let's talk about these non-conventional loans. This is what a lot of people they know about these non-conventional loans. These the loans that are backed by the government, insurance or guaranteed. We have the FHA loans, the VA, USDA loans, and also the rural loans. I can't even think of the name at the moment, but these are some non-conventional loans. All right, let's talk about the FHA loan, the Federal Housing Administration, using the four C's. We have credit. You can actually purchase a home with a 500 to a 579 credit score, but it limits to a 90% loan to value eligibility. So that means you have to have a 10% down payment. Um, for credits with 580 or plus, there should be no late payments, bankruptcies, and seriously delinquent accounts could prevent eligibility. Then we go to the capacity to pay, 31% housing to debt to income ratio, and 43% total debt to income ratio. I'm sorry. The capacity will the debt to income ratios. You don't have to worry about calculating those. The loan officer and our systems will do that for you. For cash, you need cash for closing. You need your down payment and prepayment to and prepaid items like property taxes and insurance. Don't forget that your earnest money deposit that you put in with the offer is going towards your closing account, your closing amount. Funds need to be evaluated through asset verification. Gift funds received from relative are accepted with a statement from the donor. We give you a gift letter for that, for them to sign. So that's cash verification. Also with assets, you can actually purchase your home with the cash value and life insurance policy, and also with your retirement accounts, 401k. We just need to verify it. Collateral, the third stage. Maximum loan to value is 96.5%. So that means with an FHA loan, you also need a 3.5% down payment at closing as well. And 3.5% is you multiply that by the selling price, and that's how much you will need. Then we have insurance, UFMIP, a one-time fee charged to the borrower at closing is 1.75% of the loan amount. UFM is upfront mortgage insurance premium. Then you also have loan to value is under 90% at closing. If the loan to value is under 90% at closing, you will only be required to pay mortgage insurance protection for 11 years. If the loan to value is 96.5%, meaning you're getting the maximum loan to value for the collateral, you would have to pay mortgage insurance through the entire life of having that loan. So if you can, to avoid having to have mortgage insurance protection, um, get the 10% down payment. At least a 10% down payment will be good, because if it's under 90% at closing, you only have to pay insurance for 11 years, right? So that's the FHA. This is one of the loan products. Also, a lot of people don't know that there are also other FHA products available to you. So if you want to screenshot, take a note of these loan products, because a lot of times loan officers is not going to tell you what you have available out there for you that will help you to purchase a home. So FHA product 203B, these are your fixed rate mortgages, 15, 20, 25, and 30-year terms. You don't have to get a 30-year term mortgage. You can get a 15, 20, 25 years. You may have to pay more, but at least you'll own your home quicker. Right? I'm sorry, y'all. I'm talking a lot. Then we have the FHA product 203K for rehab and repair loans. 204G, the Good Neighbor Next Door loan. It provides a 50% discount for law enforcement officers, teachers, firefighters, and emergency medical technicians to purchase a home in a revitalization areas. Borrowers must agree to live in a property for a minimum of 3 years. So we had that loan available. I'm sorry. We have the 232, the residential care facility financing. 234C, used for condominiums. 242, you want to purchase a home, a hospital financing. 245A, growing equity mortgage loans. 251, adjustable rate mortgages. And 255, the HELOC, and that's the FHA reverse mortgage product, HECM. So these are other FHA products that are available to you. Again, it's best for you to know these products. So if they don't tell you about it, you already know. You already know the name of the product, the numbers. So we have the VA, U.S. Department of Veteran Affairs loan. There are documents that's needed for this loan. You need 30 days most recent pay stubs, 60 days recent bank statements, your DD 214 form. It provides honorable release or discharge, 30 days most recent leave and earning statement, certificate of eligibility as well. To request your certificate of eligibility, the veteran must submit a VA Form 26 1880 to the Atlantic Regional Loan Center, and the COE is mailed directly to the veteran. Four legs to the table, the four C's to qualify for this loan: credit score of at least a 620 or more. But the credit report must be less than 120 days old. Capacity to pay back. They just do your total debt to income ratio. They don't worry about the housing, and that's 41%. The housing debt to income is going by how much you're gonna pay for mortgage, insurance, etc. But with the VA, they only worry about your total debt to income. They ain't worrying about the housing portion. Um, Collateral. The VA will issue a CRV. That's a certificate of reasonable value that shows the property's current market value. The VA appraisal is valid for up to 180 days, and a maximum loan to value is 100%. So you may not have to put no money down on your home. Cash, you still need to verify assets for closing costs and prepaid items. So you still will have to pay for taxes, and insurances. Um, and also the VA funding fee. You still would need that to show that you have money for that in your bank account. And the VA funding fee is a one-time mortgage insurance payment charged at the time of the closing on VA loan, ranges from 0.5% to 3.6% based on eligibility. Then we have the USDA loans. This is United States Department of Agriculture. Loans cannot be used for income producing properties. This loan allows an individual to build a home, purchase a home, refinance a home, or move a home and prepare a lot. Products available for this type of loan is 502 Direct Housing Loan Program. That's the name of the product. And it just which it requires borrowers to have a low income based on the area medium income in the single housing guarantee loan program. That's the second one. So there's two products available: the 502 Direct Housing Loan Program and the Single Housing Guarantee Loan Program. Still go by the four C's: credit, no specific credit ratings, but late payments, bankruptcies, and seriously delinquent accounts can disqualify you for a loan. Capacity to pay your loan back: 29% housing debt to income, 41% total debt to income. Um, Collateral: the maximum loan to value is 100%. Property cannot be in a flood zone, and the standard USDA appraisal is needed. And the last C is cash. No specific assets verification requirements is needed. But you also have to pay a guarantee fee, and it's 1% of the loan amount, and an annual fee of 0.35% of the unpaid balance. And it's calculated annually and paid monthly by the borrower. So once again, for each loan product, you have to worry about the four C's. So it's just not just about credit. Um, when being qualified for a loan, they also go by the capacity to pay you back, the loan back, the collateral, and your cash assets. There are also other loan products available. We have DSCR loans, just for investment properties. We have the verification of employment, which I explained a little bit earlier. We have refinance loans. You will want to refinance your home to lower your interest rate, to change your loan product from adjusted rate mortgage to a fixed mortgage, or even change the name on the title, the payer of the on your loan. We also have home equity lines of credit is available, bank statement loans. Loan Factory does a lot of different loan products. You just have to put in the application, let us know what you want this loan for, and we'll find the product that fits your needs. Now, that was it of me going over the four C's and the different loan products. So for a basic loan application, these are some basic documents that you will need handy to start the loan process and get a pre-approval. Driver's license with photo, a valid driver's license with photo, not expired. Salary, 2 years of W-2s, 30 to 60 days worth of pay stubs. If you're an independent contractor, you need 2 years of your 1099s. Passive income, you can actually use your retirement, social security, benefits, child support, alimony income to purchase a home. You would just need the award letter and bank statements providing that the money is coming into your account. If you're self-employed or commission-based, still 2 years of tax returns. You would need funds to deposit. Um, you need appraisal money, credit report money, title report, or what I would say the title agent, the closing agent funds, flood determination if it's applicable. You also need 2 years of residence history, 2 years of employment history. You don't have to be at the same job, but you still need to be working for consecutively for 2 years to purchase a home. 2 month bank statements and statements on other investments. No matter how you are employed, all borrowers will also have to sign the 4506C form allowing the lender to request your tax transcripts. And we're almost done. Let's get to the end next steps. All right, so let's talk about next steps. So 2 steps to my next steps process. On the right hand side, there are all the loans available. Um, VA, I went over this before. VA loans, FHA loans. Um, if you want to go through a regular retail bank, your credit union, that's fine. But you have a 14 to 28-day window to search for the best rates that you want, or you go through a mortgage broker, a loan officer, where you only have to put in one application, and they will find the product that's best suited for you and your needs. And we also are able to we have different loan products available. Whereas a retail bank, PNC, Bank of America, these credit unions, they have certain amount. They don't have everything that's available to you. If you want to start a loan application, my website is below. Loanfactory.com and my name, Coretta Montague-Smith. It also will give you more details about different loan products. You can get quotes for refinancing, etc. Or you can, if you have any questions, you can text me or email me. I respond much quicker with texts or emails because sometimes I'm always in a meeting on the phone where I can't be able to pick up my phone. All right. So you go through the loan, you get your loan process taken care of. Once you get pre-approved, after you receive your pre-approval letter from your lender, if you would like to use me, I could also be your real estate agent. What you want to do is, for the realtor services, you want to email me at corettamontague@gmail.com or text or call me. It doesn't matter, to schedule a Zoom follow-up meeting. Once the appointment is confirmed, the buyer's agency agreement and buyer needs analysis will be sent to you via email. And during our Zoom meeting, we will go over any questions that you may have about the buyer's representation. We can go over your buyer needs analysis and we can go over your availabilities to start showing and seeing and seeing properties. So I hope that this webinar was great, informative for you. I am I have a little sore throat, but I really wanted to get this information out there while I did have time today. And I would like to thank y'all so much for even watching this webinar. A buyer who knows what to expect is a confident buyer, and a confident buyer is much easier to work with than an anxious or uncertain buyer who will mention objections at crucial points in the home buying process just because they do not know the process itself. Once again, I hope this information presented was helpful and useful to you, and I am looking forward to working with anyone who wants that assistance in purchasing or receiving a loan um, to purchase a home or refinance a home, whatever the case may be. I am here to help. Again, my contact information is here for Montague-Smith Realty for real estate services. Office phone number is there, my email, and the real estate website. And for lending services, you can go straight to the website or email me as well. And any questions that you may have, comments, feel free to reach out. I am an open book. I just love helping people. All right, till next time. Bye.